Welcome to our comprehensive USD/JPY analysis covering November 3rd through 8th, 2025. In this presentation, we'll examine the critical price action that unfolded during this pivotal week when the dollar-yen pair consolidated near 9-month highs. We'll explore the Fed's hawkish pivot that shocked markets, analyze technical consensus from 5 major forex sources, and provide actionable trading strategies with clear risk parameters. Whether you're a short-term trader or medium-term investor, this analysis will equip you with the insights needed to navigate USD/JPY's next move. Let's dive into the data and discover what the charts are telling us about this crucial currency pair. During November 3rd through 8th, USD/JPY demonstrated remarkable resilience by consolidating near 9-month highs around the 154.00 level. The pair traded in a healthy 293 pip range between 151.54 and 154.47, with the weekly close showing a modest decline of just 0.42%. What's particularly bullish here is the market's comfort at these elevated levels. After a sharp 1.9% rally from the post-FOMC low at 151.54, buyers consistently stepped in on dips, signaling strong underlying demand. The consolidation near highs is a classic bullish pattern, suggesting the market is building energy for the next leg higher. Weekly and monthly opening ranges are taking shape just below current levels, setting the stage for a potential breakout toward 156.00. 5 major events shaped USD/JPY's trajectory this week. First, on October 31st, Fed Chair Powell delivered a hawkish shock, stating that a December rate cut is not a given, causing market repricing and USD bottoming across all pairs. November 3rd saw weak ISM manufacturing data, which had limited impact. The game changer came on November 4th when Japanese officials engaged in verbal intervention near 155.00, triggering a temporary pullback to 153.27, though this was viewed as a short-term fix. November 5th brought strong U.S. economic data. ADP beat forecasts and ISM Services PMI exceeded expectations, yet paradoxically, USD failed to extend its rally, signaling a short-term top. Finally, November 6th saw a risk-off episode with buyers returning at the critical 153.00 support level. Remarkably, all 5 major forex sources we track, TradingView, investingLive, ActionForex, Forex.com, and DailyForex, converge on a bullish outlook with targets at 156.00 to 158.00. investingLive notes that while USD strength may be running out of steam, the upward trend line remains intact with buyers stepping in at 153.27. ActionForex identifies consolidation below 154.47 with a neutral bias, but highlights that a break above targets 156.05 as the 100% projection level. Forex.com describes the setup as coiling below resistance with a breakout building, emphasizing the ascending pitchfork pattern from October lows. DailyForex maintains that the uptrend is still intact, recommending buying dips toward 153.00 with a 158.00 target. The consensus is clear. 153.00 to 153.27 is critical support. 154.47 to 154.82 is the breakout level, and 156.00 to 158.00 is the target range. Let's define the battle lines. On the resistance side, we have 4 critical zones. First, 154.47 to 154.82 represents the immediate breakout level. A close above 154.82 confirms uptrend resumption. Second, 155.00 is the psychological level, where Japanese officials have drawn a line with verbal intervention. Third, 156.00 to 156.05 is the primary target, representing the 100% projection level with a 75 to 80% probability of being reached. Finally, 158.00 to 158.85 is the medium-term structural resistance. On the support side, 153.00 to 153.27 is critical near-term support that has held firm multiple times. Below that, 151.52 to 151.63 is the major support and bullish invalidation level. The 50-day EMA at 150.66 to 150.74 provides dynamic support, while 150.00 is the major psychological support level. For the next 1 to 2 weeks, we're looking at an expected range of 151.50 to 156.00, with bias toward the upper end. The bullish scenario carries a 65% probability. A daily close above 154.82 would target 156.00 to 156.05 within 5 to 10 trading days, driven by continued Fed hawkish rhetoric and strong U.S. data. The neutral scenario, with 25% probability, involves choppy consolidation in the 153.00 to 154.50 range for another week or two, eventually resolving with upside, more likely. The bearish scenario, at just 10% probability, requires a close below 151.52, targeting the 150.00 to 150.66 zone, likely triggered by major risk-off events or actual intervention. Our recommended strategy: buy dips to 153.00 to 153.27 with stops below 151.50, targeting 156.00 for a risk-reward of 1 to 2 to 1 to 3. Looking 1 to 3 months ahead, the structural drivers strongly favor USD strength. The interest rate differential of 350 to 400 basis points between the Fed and BOJ provides a powerful tailwind, generating 3 to 4% annual positive carry. Policy divergence remains stark. The Fed maintains a hawkish bias with December cuts uncertain, while the BOJ stays dovish with the next hike delayed to Q1 2026. Economic fundamentals support this divergence. The U.S. economy shows resilience with strong services data, while Japan faces demographic headwinds. Our base case, with 60% probability, projects a gradual grind higher to 156.00 to 157.00 over 2 to 3 months. The bull case, at 25% probability, sees an accelerated rally to 158.00 to 160.00 if the Fed rules out December cuts. The bear case, just 15% probability, involves correction to 150.00 to 151.00 on major risk-off or actual intervention. Probability of reaching 156.00 stands at 75 to 80%. Let's address the downside risks with clear probability assessments. First, actual Japanese FX intervention carries a 20 to 30% probability with potential 300 to 500 pip impact. While verbal intervention has limited effect, actual market intervention could trigger sharp reversals. Mitigation: use stop losses and reduce position size near 155.00. Second, global risk-off events have 15 to 20% probability with 500 plus pip impact, as JPY's safe haven status causes rapid carry trade unwinding during financial stress. Mitigation: monitor risk sentiment and reduce leverage during volatility. Third, a Fed dovish pivot has 10 to 15% probability with 300 to 400 pip impact, as emergency cuts would narrow the rate differential. Mitigation: monitor Fed communications closely. Finally, a BOJ surprise rate hike carries just 5 to 10% probability but 500 plus pip impact if inflation accelerates, or yen weakness becomes politically untenable. Mitigation: monitor BOJ communications and Japanese inflation data. Now let's examine the upside opportunities. A Fed hawkish surprise carries the highest probability at 30 to 35%, with potential 300 to 400 pip impact. Strategy: add to positions on hawkish Fed signals. Second, BOJ further delaying tightening has 25 to 30% probability with 200 to 300 pip impact. Strategy: hold positions for longer-term targets. Third, improved risk sentiment carries 30 to 35% probability with 200 to 300 pip impact. Strategy: increase position size during risk-on environments. The overall risk-reward assessment is favorable. Downside risks are low to medium probability but high impact, while upside opportunities have medium probability. This asymmetry favors long positions with appropriate risk management. The key is maintaining disciplined stops while allowing winners to run toward our 156.00 to 158.00 targets. Let's get tactical with specific entry and exit levels. For position management, existing longs should hold core positions with stops below 151.00, adding on dips to 153.00 to 153.50. Take partial profits at 156.00 and 158.00. Trailing stops to maintain a 200 to 300 pip buffer. For new positions, aggressive traders can enter at 153.00 to 154.00, with stops below 151.00, while conservative traders should wait for a breakout above 154.82. We've outlined 4 specific strategies. Aggressive long enters 153.00 to 153.50 with 151.00 stop, targeting 156.00, then 158.00 for 1 to 2 to 1 to 3 risk reward. Conservative long enters above 154.82 with 153.00 stop, targeting 157.00, then 159.00 for 1 to 2 risk reward. Swing long and breakout. Long strategies offer shorter-term alternatives. Best times to enter are Asian session pullbacks and post-intervention weakness, while best exit times are European-US session rallies at key resistance levels. Let's synthesize the 8 key takeaways from our analysis. First, USD/JPY consolidated near 9-month highs at 154.00, building a breakout setup. Second, the Fed's hawkish pivot and BOJ's dovish stance create a 350 to 400 basis point rate differential favoring USD. Third, all 5 major sources align on bullish outlook with 156.00 to 158.00 targets. Fourth, short-term outlook shows 65% probability of breakout above 154.82, leading to 156.00. Fifth, medium-term outlook shows 75% probability of reaching 156.00 with a base case of gradual grind higher. Sixth, key support at 153.00 to 153.27 and resistance at 154.47 to 154.82 define the battle lines. Seventh, risk management calls for buying dips to 153.00 to 153.50 with stops below 151.00 for 1 to 2 to 1 to 3 risk reward. Eighth, primary risks include Japanese intervention, risk-off events, and Fed dovish pivot. Bottom line, the structural trend remains bullish as long as Fed stays hawkish and BOJ remains dovish.